Hey everybody, welcome back to Ryan Makes Sense, where we talk personal finance, investing, and chart analysis. We do have a viewer requested video today. This is the Amplify High Income ETF, ticker symbol YYY. We're going to look at the top three holdings within that ETF to kind of get a bigger, better picture of why the ETF is performing the way it is. We'll look at what happened if you bought the ETF back when it first started versus today. We'll look at why I think this type of ETF is often a trap and much more. And we'll actually work together to scan for a dividend that not only goes up but pays a nice premium. So again, just work with me here. So a ticker symbol YYY. This stock was $23 back in 2014. Let's say you bought 100 shares of this ETF. Okay, 100 shares at $23 times 23. You have $2,300 worth of this ETF, and it pays, let's say, a 12% dividend, just to be rounded up. Gosh, my mouse. Okay, so now we're going to times this by 0.12. So we're going to get $276 for that year, but we're going to divide it by 12. So we're getting $23 a month essentially. But the thing that sucks is our 100 shares at 23 have now lost almost half of the value. So we have our 100 shares at now $12.08. But we're getting again, 12% return on that money. So now we're only getting $144 for the year. Divide that by 12. We're getting $12.08 a month, basically, which not only has our principal gone down, we're getting paid less. And the thing that attracts people to these types of ETFs is a very high dividend. I don't want to call it a trap, but these types of high dividends, typically the stock just continues to go down into perpetuity. Um, at no point, I guess one point, if you bought this during the total mayhem of the pandemic at $9, you are up um, barely. But anytime other than that, you are underwater, unfortunately. Right here was an opportunity as well back at $10, but it's let this thing continue to play out and it's going to prove to itself which way it's going, which we can see. Let's look at the top three holdings in the ETF: Oxford, PIMCO, and Eagle Point. I do have them all right here. You're going to notice something similar. We're on the monthly chart. Look at the same pattern here, and you'll notice the dividend is almost 17%. That's pretty crazy, right? Again, you are underwater unless you bought during the pandemic hysteria at $2. You're up, but again, at what price? You know, your principal's only going down. Your payments each month are going to continue to go down because the stock price, the ETF price is going down. We're going to look at PIMCO. This is number 2 on the list. This one, you're basically above water if you bought during the pandemic mayhem hysteria, and also recently here at $15.45. So again, this one actually looks like a potential bull flag, meaning a move up. And this one pays a 13.88% dividend, but uh it pays you every month, but I mean at what cost? Like what if you bought at $28? I mean your principal's going down. It's it's just not a good, healthy, sustainable investment for the long term, in my opinion. And again, this is number 3 on the YYY ETF. Again, you are above water if you bought during the pandemic hysteria and also here in October at the low of $8. And this is a 16% dividend. So this one is apparently super cheap. This one's apparently super cheap. Apparently super cheap. And why does not have an ETF or a PE. So apparently these are undervalued, but at what cost? So I would typically, I'm not a financial advisor and I don't give professional advice. I typically avoid these just because they are traps. You see 16%, you have 100,000, you're like, oh my God, I could make 16,000 a year, put my money here. But your 100,000, I mean, overall, it's just, I mean, look at the trend goes there and now we're here. So, and that same trend line follows all of these. And you can see this orange line here, which is our average. This orange line here, which is our is that a 50? Yeah, it's our 50-day moving average. So um, I would avoid these types of traps with high dividends, but let's go ahead and see what we can find. Maybe we can find a company that pays a juicy dividend and the stock actually goes up. So when you buy 100 shares at $100 and fast forward 5, 10 years, now your shares are worth $200 or $300. I mean, you've doubled your principal and you're getting paid every month or every quarter. That's pretty fantastic. And one I think that we can mirror that's very popular is Home Depot. We're not going to essentially mirror Home Depot per se. I just want to take a look at the data points here really quick. Maybe. Here we go. I mean, look at this. Imagine buying at $125 and you're getting paid 2.6%. And now your investment has almost tripled. So if you put $100 in, now you're getting it tripled to 300. So something like this, I would want to see EPS growth past 5 years. Yeah. So looking for EPS growth past 5 years, we want over 10%. And we just basically want to look for something that's been consecutively kicking butt. And we'll do sales past 5 years. Yes, right here, over 5%. Wonderful. We also want profitable. We want them to be profitable. Net profit margin to be positive. All right. Now we're down to 750 stocks out of like 5,000. We want them to pay dividends. So dividend yield, let's do over 5% and see what we get. 69 stocks. Okay. And just looking, we have REITs, we have oil, banks, asset management, retail, airlines. So really pick your gambit of what you're comfortable in, what industry. Something that could give us a little bit more comfort is performance year to date is up. Actually, we might want to be looking for year to date down so we could find an opportunity, but I'm just doing this as an example. So the stocks are up. They pay over 5% dividend. Um, gross margins. Ooh, let's do over 15%. Okay, we have 31 stocks now. We're going to watch it go down to maybe 10, 23. Okay. All right. Maybe you want a company that has billions of dollars in market cap because they're a little bit more stable. And you would just change that up here, but we're looking for uh, other, maybe you want institutions to be buying the stock, which you could do right here. I mean, we have 23 stocks here, so I think this is fine. And let's just click this charts button. And we'll select a few stocks just to take a peek. A peek see. I mean, look at these dividend paying stocks. Up like 30%, up 20%. I mean, these look really good. Sig, is that cigarettes? Nope, it's oil. So, I mean, I would feel better about something like this, and even just for a little bit more comfort, we'll do plus mid. So ETF stocks over $2 billion. Now we have 10 stocks, and let's just look at a couple. We'll look at Antero, we'll look at Alliance Resource Partners. Let's look at Maine, and let's look at Star Bulk Ship Carriers. Okay. And when I say look at them, we're just going to look at the chart and look at the financial data points and see what we can find. And if you wanted to be diversified, you don't want to be in one single stock because being in one single stock is very risky. You just go down here and you can do. So here's the ETF filter here. But you can also go to this ETF tab. My head is right in the way, actually. I don't know how long I've been in the way. So let me move my head really quick. So there's the ETF. Oops. There's the ETF tab right under my head. It does not. Oh my gosh. Whoa. Okay, I think you guys can see everything. I don't know. We'll leave it. I don't want to mess with it. Okay, here's the ETF button. So we could just click here. And again, you could do the same kind of thing. These are not ETFs. These are individual stocks. We can reset and do the whole gambit, but yeah, we're just looking at individuals for the moment. And we'll look at the monthly here on a couple of these because we were looking at the monthly for YYY and the other 3 stocks. I mean, this looks good. Okay, so we're looking on the monthly here for AM, and you would be underwater if you bought before August 2018. If you bought during the COVID hysteria at $2, you would be up almost 1,000% at a 6% dividend. Oh my goodness gracious. That's pretty insane. ARLP, you are underwater if you bought when the Great Financial Crisis ended. Ooh, if you bought in 2000, you're up almost 1,000%. If you bought during the COVID hysteria, you're up almost 1,000%. Wow, down here. And they pay an 11% dividend. That's a little bit of a trap, but I mean, look at the sales. They have sales, they actually have EPS. I like this. So let's see. Some selling, no really red flag selling. So again, there are other options that aren't as trappy. Ooh, look at this one. Ooh, this one is a killer. Maine, a 7% dividend. Wow. And look, you're no matter when you bought it, you're above water. There's not one point. If you would have bought this any time before this month, you're up. So clap, clap, clap. We found something great, which is cool because we didn't have this planned. I didn't have this planned. All right. And then we'll just look at this last one because we looked at the others and why not? While it's loading, drink water. All right, this one looks a little choppy. This one you are underwater if you bought at certain periods of time. Wow. Yeah, if you bought any time before 2014, you're underwater. If you bought from 2015 to 2021, you're up. And then it's just kind of been trading sideways. And it's got a 12% dividend, which is freaking insane. Uh, Sales here, I mean, they're trickling with a billion here. EPS going down. I'd probably avoid this one, stay on the sidelines. Um, so I kind of showed you how to scan for your own uh, stocks for companies that have a 5% plus dividend. They're profitable. They're up this year. Sales are have been positive over the last 5 years, and gross margins over 15%. EPS growth is positive, and their market cap's over 2 billion. So very fun stuff. If you made it this far, consider dropping a thumbs up or thumbs down. Leave me a comment, maybe subscribe, and I hope you have a wonderful day. Goodbye.